The stock market is becoming a reality show and a circus. Those are the words of one of the heads of a bank in Spain. So why is he saying this? Is it true? And if so, what does it mean for you as an investor? Well, that's what we're going to look at in this video. So let's get right into it. Welcome back to Millennials with Money. I'm Johnny, and those were the words of Juan Carlos Ureta, who is the head of Renta Bank here in Spain. I saw this headline in Cinco Días, which is the economics and finance section of a major newspaper here in Spain, and obviously it caught my attention. Why wouldn't it, something like that? And so I decided to have a read of it, and what he says in the article is actually very interesting, and when you read it in its full context, it actually makes perfect sense. So these comments that he made them while speaking at an event called The Impact of Minority Investors on the Stock Market. And he was speaking alongside the ex-president of Spain's Comisión Nacional del Mercado de Valores, which is also known as the CNMV and is equivalent to the likes of the FCA in the UK, just to put that into perspective. So he starts out by saying that the internet and social media has made the spread of information more readily available, a lot more quickly available, and a lot more accessible to investors, which is obviously a good thing because in theory it means that the market is much more efficient and all that information gets priced in to the price of a stock on the market. The next part, however, is where the context of his comments comes into effect. Obviously, with information being more widely available, with social media connecting people, it makes it more easier for people to team up and create pages like Wall Street Bets and gang up together to try and force the market in one direction. This is where he says, of course, when people are simply investing not based on fundamentals and based on hype, this is where the stock market becomes a reality show and a circus. And then to add on to Ureta's comments, Conte, the ex-president of the CNMV, said that when a lot of small minority investors participate in the market, it's not good for its efficiency and it creates more volatility, particularly when you have situations like this, when people aren't really investing based on fundamentals. Now, hearing these comments as a retail investor, as a minority investor with not a lot of capital, this can sound very much like a us versus the system kind of argument. But let's just take the facts. Is what they're saying true? Does it hold true to any extent? And the answer, in my opinion, is yes. Think about it. Platforms like DeGiro, like Trading 212, like Stake, like Free Trade, are making it very easy for investors with not a lot of capital to invest. In the case of Trading 212, you can invest from £1 or €1 and you can buy fractional shares on the platform. So that means anybody can get in. The barriers to investing have completely been removed. If you want a free share on Trading 212, by the way, check out my video description. Got a link there. You'll get a free share. I'll get a free share. Everyone's a winner. That said, now that the barriers have been removed and that anyone can get in, that means there's more likely to be people who speculate on stocks, who invest without really doing proper research and just put money in companies that they like, for example. And of course, you've got extreme cases where you get gangs of people who group together on social media and pump up the price of stocks. Yeah, I studied a bit of this during my master's program, and the name for these kinds of investors and traders is called noise traders because they add noise to the general workings of the market and they add volatility to it. Now you're going to be telling me, Johnny, a guy who puts £10 in Tesla or £10 in Amazon, he's not going to break the market. Yeah, sure. But like I said, now that the barriers have been removed, you got a lot more people who are possibly doing the same thing. And the multiplied combined effect, that's what can create these market movements. In addition, we're in the middle of a pandemic. We've been through an economic recession last year. There's potentially more economic repercussions to come down the line, all of which creates uncertainty. And with uncertainty comes opportunity for speculation, risk-taking, gambling, let's call it. And as everyone takes their positions and events start to play out, whether for better or for worse, you'll get a lot of people who are cashing out or a lot of people who panic sell when they lose. And as a result, that adds further to the market volatility. Let's not forget, by the way, our market volatility. The richest man in the world has changed 4 times in the past month as a result of stock market volatility. Okay, greater volatility. So what does it mean for you as an investor? Well, obviously, as an investor, you're investing because you want to make a return on your money. You want the best chance. What does it mean for you as an investor? How can you come out a winner in times of market volatility? Well, the first thing to do is go in with a long-term mindset. You need to invest long-term because over the long term, Market volatility in the short term tends to even out and the market generally trends upwards. It doesn't mean it will do it for definite, but history has shown that that is the general course it takes. So the more time you are in the market and the longer horizon of investment you have, the greater chance you have of coming out at winning. Don't get sucked into the short game, don't get sucked into trading, don't try and speculate on stocks hoping for a quick rebound, because more likely than not you'll come out losing money, and as an investor that's obviously not what you want to do. Another way to come out a winner is to understand that individual stocks generally underperform the market. So if a lot of your investments are in single stocks, it's more likely that you will underperform. The best way to perform close to or on par with the market is via index fund or ETF investing. Now, index funds and ETFs typically replicate the performance of a market. So obviously, if you're investing in line with the market returns, then you're going to be more or less on track with what the market earns. I myself invest in ETFs and index funds, and I'm actually trying to increase the allocation that takes of my portfolio. And if you want to have a look at the ETFs that I'm investing in, you can check out my Trading 212 series, which will show you a bit about the ETFs that I invest in and which markets in the world that I'm trying to follow. If you do decide to invest in individual companies, however, then your best bet is to invest in companies with good business fundamentals that have a long-term sustainable competitive and economic advantage, and that have good financials, and ideally companies that pay a dividend as well. And last but not least, please don't panic sell. Don't do it. It's not a good idea. You haven't lost money until you sell. Trust me, it's painful. I know my portfolio went down 30% at the start of last year as a result of the pandemic, but it has recovered. It's back in positive now. So just to show you that the market does recover, that long term you can come out a winner still, and that you haven't lost money until you've actually closed a position. So keep that in mind. Don't panic sell. Over the long term, you're more likely to win. So if you like today's video, why not hit the subscribe button if you're not already subscribed, and click the notification bell so you don't miss a video when they come out. Also leave a comment. What did you think of Juan Carlos Ureta's comments? Do you think retail investors are adding to volatility? And what do you think of the current stock market environment, and how are you dealing with the volatility that we're facing today? I'll see you on the next one, and let's get this money.